The Dow has closed over 11,000 for the first time since April, but we're heading into a holiday weekend with a weak jobs report and Treasury yields at record lows. Is a new round of Fed stimulus a foregone conclusion? Joining us right now is PIMCO's co-chief investment officer, Bill Gross. He runs the world's biggest mutual fund, the $248 billion Total Return Fund, and helps manage PIMCO's $1 trillion in total assets. Bill, always good to get some time with you. So in terms of the market reaction today to that jobs report, we're all saying, you know, it's not a great report, but we've got the equity markets up and we're seeing some enthusiasm in the market. Does that make any sense? Or of course it does, because the QE, you know, we're going to get QE2 here.
Sure, that's all the sense that you need, or that's the only fact that you need to know, at least at the moment. Ultimately, when you get QE2, you want real growth, you want corporate earning growth. But, you know, for the moment, to the extent that the Fed comes in writing $1 trillion worth of checks over the next 12 months, then that lowers interest rates and that makes stocks all the more competitive in terms of their yields, and that's what happened today.
But all that more competitive, but doesn't it make it dangerous? At some point, you know, Bill, there's going to be a tipping point. And we all hear about a bond market bubble. We were just talking about it in our last roundtable. I mean, at some point, this has got to be dangerous. Don't investors, especially, you know, mom and pop investors, have to be careful at this point about their exposure?
Well, it's dangerous from at least two angles. One, from the standpoint of the currency. To the extent that the Fed writes $1 trillion worth of checks, that certainly doesn't do much to support the value of the dollar, and we saw that today as well, and we've seen that in the past few weeks. The dollar goes down, and our standard of living goes down. Secondly, to the extent that it lowers bond yields, and yes, the 2-year at 37 basis points, and you know, 5 years at 1.13%, then obviously that's not very much of a return. And to some extent, when you go out to 10 and 30 years, if inflation is the result of this check writing, then yes, there's some principal risk ahead.
Yeah, I wonder about the risks of inflating another bubble, and you don't know where, you don't know how, but the unintended consequences. I mean, there was a lot of talk back in 2003 that Alan Greenspan should do his own quantitative easing and set higher inflation targets to try and create a housing bubble to alleviate the pain that we had from the internet bubble, but we all know that didn't end well.
Well, let's look at it this way, Matt, in terms of trying to analyze whether or not it's a bubble. What the Fed is trying to do with this program is to reflate the economy, the U.S. domestic economy. What they're targeting, and we heard that this week with Charles Evans and last week with Bill Dudley, and you know, to some extent with Brian Sack as well this week out here in Newport Beach. We heard that they're trying to get to at least 2% annualized inflation, and maybe even hit a price target that would allow for more over the next several years. So to the extent that they're trying to prevent a caving in of the U.S. economy, perhaps it's a little bit bubblish, but 2 to 3% inflation is not the housing market of 2006 and 2007. So until we get there, I don't have that many concerns, and I don't think the Fed does either.
Do you worry, though, Bill, about inflation getting out of control? I mean, we all hear about concerns, the hyperinflation concerns, that once it starts, it's very difficult to stop it picking up pace.
It is, but we're so far away from that, Matt. You know, we are in what many managers and analysts and even you know, Fed governors would describe as a liquidity trap, and that basically means that, like you've talked about in the last 10 to 15 minutes, it means corporations don't invest money because they don't have animal spirits. They don't even have expectations of inflation. So what the Fed is trying to do is generate some inflationary expectations, and yes, basically the theory is that 3 or 4 or 5 years down the road, they'll worry about it at that point.
Bill, what's going to be the best thing, though, in your view, to kind of turn around sentiment in corporate America at this point? I hear different stories. They're worried about, you know, tax policy, regulatory policy, lots of different things. What do you think, though, gets those animal spirits going in corporate America?
Well, I don't think there's much left, Carol, to be honest about it and to be practical about it. Analyzing fiscal policy in Washington, we have a 10% plus fiscal deficit, and we have Republicans and Democrats at each other, and so no real expectation for new programs. The only thing left is really the Fed in terms of quantitative easing, lowering interest rates, promoting animal spirits, as Alan Greenspan mentioned, and you just, you know, showed the clip. To the extent that you can promote a wealth effect and a trickle-down type of wealth generation, allowing corporations basically to have rejuvenated spirits and to invest money for a consumer market, then that's all we've got left. And if this fails, it could have significant problems in terms of a lost decade for the United States.
I wonder, Bill, we've been talking today. We talked with Al Broadus about it earlier and have mentioned a couple times that the Fed apparently, according to the Wall Street Journal, has internal targets. If it buys $500 billion in treasuries, it would only boost GDP by 0.2% and reduce unemployment by 0.2%. Do you think those are unrealistic targets? Because if so, then it doesn't seem that QE of $500 billion or even $1 trillion or even $1.5 trillion would really work that well.
Well, the Fed does want real growth, and the Fed, I think, recognizes that they can't immediately get lots of real growth from this check writing, but they're willing to take nominal GDP growth if that's second best. And what that basically means is that inflation targeted at 2 to 3%, along with a semblance of real growth, perhaps in the 1 to 2% area, produces nominal growth of 5%. And that's what this economy got used to for the past 20 years, and that's what the Fed needs to prevent in terms of a debt liquidation. If we don't get 5% nominal GDP over the next year or two, then yes, corporations and households begin to cave in terms of the massive amount of debt payments that isn't being supported or serviced by nominal GDP growth. So yeah, they want real economic growth, but they'll take inflation if they can't get it.
Is it a concern, though, if you see, and again, the Wall Street Journal mentions today concerns about oil prices rising and other commodities rising, that kind of has a negative effect on growth?
Right. That's not the inflation they want. That's the risk. That, if the dollar goes down and if you see inflation coming through imports in terms of oil and commodity types of prices, that doesn't do anything for wage rates and for employment. So, they're not all positives or potential positives from this type of program. So the Fed has to watch it carefully to make sure that the benefits are accruing to the U.S. economy as opposed to foreign nations and oil exporters.
All right, we're going to leave it on that note. Bill, thank you so much. Bill Gross there, everyone.
Wait, hang on, Bill. Can I just ask you quickly? We only got 10 seconds, but what do you think the Fed inflation target should be? Do you think 4% is the right one, as Blanchard has suggested?
I think 2.5 to 3%. I mean, we've been below 2% for several years at least now, and so to get back up to the price level that they're suggesting, we need at least 2.5 to 3%. That's not a good number for long-term bonds, and that's why long-term bonds are not moving higher in price and are moving higher in yield.
Got it. Thanks. Thanks, Bill.